Yeah, we've got Mark Young with us. I do want to say, first of all, I think it's perfect timing because we have had such volatility in the market. And Mark does, as you can see, he's President Director of Research for Wall Street Sentiment and is also publisher of the Wall Street Sentiment newsletter, specializing in investor psychology and technical analysis. Mark, it's great to have you on the show today. I know you've got some great information for our viewers. And, with the volatility up where it is currently, we haven't seen this in quite some time. The back and forth action, these huge moves, as I pointed out earlier in the show. What do you make of all this in terms of sentiment? I mean, do you think that the sentiment? I guess maybe let me just let you go ahead and do your presentation. But I've got some questions, but maybe you'll answer them before the show is over.
Well, we do have our poll up before you show your charts that I know you brought. And we asked our viewers if they use sentiment in their analysis. And 41% did say yes. But we do have 11% out there that don't understand, what is sentiment. So it'll be interesting for your presentation, knowing that, about 10% of the people out there aren't really familiar with sentiment.
That's it's actually not surprising. It's sort of an arcane part of technical analysis, but it's useful. I have to say, over the years, I've used it as a key part of my analysis. Frankly, since I started running the Wall Street Sentiment Survey, which used to be the Fearless Forecaster Sentiment Survey that your dad originated.
Yes.
And as you go into this business, you're always looking for something that other people aren't doing. Initially, when I looked at sentiment, it was sort of the definition of what other people aren't doing, because I was looking at what people were doing in mass and saying, well, if everybody's doing it, I maybe don't want to be doing that. And that's the classic way of using sentiment. If everybody's bullish, maybe I shouldn't be bullish.
Right.
If everyone's bearish, we should probably be looking for a low. And that's classic for a reason. It works. It's very effective.
Absolutely.
But the nature of sentiment is such that, well, when people are bullish, that doesn't necessarily mean they're wrong all the time. Some of them are right. In fact, some people are smart enough to see a rising trend and know that they want to be with that rising trend. Similarly, sometimes when things are ugly, you want to be out of the market and you want to stay out of the market, because that extra spike in volatility can be rather painful. So anyway, my first chart here I wanted to look at is the relative VIX, and we were just talking about the VIX and the VXN, and I always want to contextualize sentiment, and what the relative VIX does is it puts it in context with a long-term moving average. And this is a very old indicator. People have been using it for decades and decades. Well, at least 3 decades anyway. As long as I've been in the business, which is about 35 years, people have been using it. It doesn't give a ton of signals, but when you see the relative VIX go above about 1.4 seems to be the magic number. It can be a little lower, a little higher. You can see back here in 2016, we had that spike. We made a low. Market took off, never looked back. We got had a little pullback again early last year. You can see the relative VIX spiked, kind of got close to that buy territory, didn't quite get there. And of course, the market not only took off, but accelerated. But on this last pullback here, when the VIX was so low, you saw a huge explosion in that. And I think, it kind of came to me while we were talking here, but it seems to be kind of reminiscent of what happened in 1987. And I don't want to compare this to 1987 per se, but just conceptually, in 1987, there's a lot of new program trading, portfolio insurance, there was index arbitrage, and having lived through that, it was clear to me that the powers that be in the market were totally unprepared for the implications of all that new technology in trading. And the selling fed on itself, and people who were normally the smart money, who knew what to do, were kind of caught wrong-footed, and the volatility exploded, and panic ensued. And then when it was done, the world was still, running just fine, and we didn't go into a massive recession, and the market turned around and proceeded to rally on again. That kind of reminds me of what we saw here with the big spike in the VIX. We saw that all those low VIX readings and that explosion in VIX derivatives. I think people were caught wrong-footed. I don't think they were prepared for what that really meant in the marketplace, as big players perhaps were either buying or selling premium and then hedging it and doing other activities in the market that were perhaps non-traditional or unexpected, that really had no meaning whatsoever with regard to perception of value or investment utility, but rather they were just trying to do a program to capture some of that premium or hedge against an further expansion in premium. Whenever you see wild moves like that in the market, that usually there's something amiss. It can be mass margin calls, or it can be something mechanical like this VIX situation. In any case,
Mark, before you go on, we're getting a lot of questions. They're seeing this chart and they want to know what is the relative VIX and how you calculate that.
Okay. What I do is I look at a 200-day moving average of the relative VIX, of the VIX, and then I measure it versus the current VIX reading, and that gives us our relative VIX. It's a rather simple calculation, and it only gives signals, every several months at best. But what it tells you is that when the VIX has spiked enough above that long-term average, there is at least a motive to rally the market and capture some of that excess premium. And that's what we're looking at right now, in fact. It's screaming, we're near a low. We're either at or near a low of some importance, just as it did, back last month. I would, and because things, the VIX panic, has been dealt with. In fact, some of the inverse VIX ETFs have gone away. That to me says we shouldn't expect a reading such as what we had last month. That's an anomaly created by a unique situation. So that really means that these readings up here, we're at 1.78, I believe, if I remember the calculation from last night. It doesn't show on the chart, but we can see we're rather near that 2 level. That's anomalous. You don't see that very often. That to me says we've got big time motivation for a rally of some import here. This isn't a scalpel tool. It could be off by a few days. You can see last time it spiked before the low hit, and if you bought a little early, you had to take a little heat. You got bailed out, and that's also important. But we should use this as an indicator of there's opportunity here on the long side. Is the low end? Golly, it's hard to call. These are always tricky. I think it's the type of environment where you look at all your indicators and see if you get a clue from them as to what the next direction is going to be. Any other questions on the VIX?
Nope, that was the main one. Yep, that was pretty much the main question: how to calculate it and what it was.
Yeah, I have one other comment maybe to add there, Mark.
Sure.
And that would be, I agree with you. I think when the volatility index, the VIX, the VXN, reaches certain levels, that's when I start looking for a reversal. The problem is that sometimes you're a day or two off, and when you're in a panicked market like we are now, 1 or 2 days can mean a lot in terms of percentage. So have you done some kind of a study where you look at a reading on the relative VIX and then see maybe 10 days out or 15 days out what the market has done? Because it's hard to catch that exact bottom,
Sure.
when the market is panicked and fearful. And, I know because I trade, sometimes it makes it really tough to, even though the market might be getting close to a bottom, you don't want to jump in right in front of that freight train and get, run over right before it bottoms the next day. You know what I mean?
Oh, so absolutely.
I'm wondering if you've done
though I will tell you that usually that fear of of the further downside is usually, disproportionate to the actual pain you have to suffer. If you're early, you only have to suffer through a couple days. Now, if you've got stops in there, that's a very real risk. And yes, we do need to be mindful. Now, in the past, I've done some studies, but I've found that it's more of a window of opportunity, and it's usually 4 or 5 days. It's not a big window. I feel like we don't get enough important signals to have a strong statistical confidence level about how much time you have to wait. In fact, I fear that if we use that alone, we could find ourselves finding excuses not to be buying when in fact we should be buying. Because there's no rule that says it has to go 4 days to a low. It might be the day it hits that 1.4 that the market turns, or it might be day 4. It's hard to know, or it could be day 5 either. These things, you can get a fair amount of volatility and variability. So what we need to do is look at other tools, and I think you're doing exactly the right thing by looking at looking for a reversal bar. We didn't used to be able to trade VIX. I guess you can trade VIX now, but I used to say you don't trade the VIX, you trade the S&P or the market. So what you want to do is you want to look at a chart of the market and see what that's telling us. And I'm just going to jump ahead and grab a chart that we can look at to give us a view of the market. This is an AIM, but what's important is the chart action you're seeing. You see that big down spike, and then that big huge rally, and then a retracement of that. That's your heads up that maybe we're making a low of some sort. Now that final stick is going to be your confirmation. That will give you a lot more confidence in that low. The one you were looking for, that nice big reversal stick, that's where your confidence is highest. It also means almost assuredly you're going to have to leave some on the table. That's usually the price of confirmation. And I've, as a trader, I'm emotionally inclined to want to have that confirmation. But I've been at it long enough to know that I've rarely paid much of a price for picking my spot and just jumping in before that confirmation occurs. I don't need to jump in all the way either. I can just put a small position on and then add to it as well in case I'm early. And I don't sweat that too much when we get those big high VIX readings, because I know we're not too far from that low. We're not going to have to suffer too long. It's much better to be early picking a market low than it is to be early picking a market top. Anybody who's been at this a while knows how absolutely painful it can be when you see this beautiful top setup and then the darn thing just turns around and just keeps rallying another 10, 15%. But much as we saw most of last year, or all of last year, really. The cost, our job as investors is generally getting into the market. Getting out of the market can be hugely useful, but that requires a good deal of, I think, patience and confirmation. Whereas getting into a low, well, we're rewarded sometimes handsomely for being in there at the very early parts of a low. You can be up 3-4%, 5% even before you get much confirmation, and that's that can be half your for a money manager, that can be half your performance for the year. And if, for instance, you were in a leverage position, well, heck, you've got to jump on everybody if you got in early on. You don't want to be too leveraged, obviously, when you're picking a bottom. And personally, I think it's imprudent, but certainly if you're in there trading, I think you can be well rewarded for waiting only for the proper pattern. I think we're currently in a pattern that's very indicative of low. I think we're within days, if the low might not. I mean, low could actually already be in as we speak. It's just one of those things. It would be neat if we tested those lows down there, as you mentioned before. That would be a very nice pattern, especially if they held and we had a reversal stick. The Elliott wave, people might expect it to go a little lower than that. Even within that context, I think we can have so much confidence in a greater rally because of where the relative VIX is, and where the fear and greed index is, that there's a lot of fuel for a rally in here, and that rally could be rather significant. I pulled up CNN's fear and greed index here. This is also not a scalpel-like tool, but it does give you a pretty good idea of where the sentiment is. You don't get much more fear in the market than what you've got right now, and it's not like it was near the top where we were showing extreme greed. This is kind of a confirmation. They look at some of the same things we do, but also some different things. But that's a nice confirmation to know that this is a zone where we should be looking for a low of some sort. We don't have to be that good, I don't think, to pick that absolute low. We want to get in there in the general zone. If you're a little bit risk averse, you can wait for that upturn, that nice reversal stick. That'll lend a lot of confidence to your buying. I too believe that we're in a bull market. My indicators, I like to look at some long-term charts. My weekly charts are saying we're still in a bull. It's still acting like a bull. We're still technically in a correction, certainly, but all the context says we're in a bull. We're likely to get bailed out if we are early, and there's a lot of motive for people to take the stocks higher in here, in the near term. So, the odds, the wind is sort of at our back for the bulls. I do want to mention the commercial paper situation. Now, I view this as sort of a measure of smart money sentiment. The people who are lending money to financial institutions versus the people who are lending money to non-financial institutions. The people who are lending big money to large desirers of capital, if you will, big companies, they're going to know the business pretty well. They're not getting a whole lot of return on that money, so they don't want to be kicking a hornet's nest or buying a pig in a poke. They want to have good familiarity with the business. So I like to look at whether or not people are demanding a little bit more of a premium to lend money to financial institutions versus non-financial institutions. Financial institutions tend to have more leverage, so they're more of a indicator of health of the financial sector in general. And if the economy is going into trouble, it'll oftentimes show up as trouble in the financial sector. Also, if the market's going to get creamed, it'll also show up as additional risk, perceived risk in the financial sector. Recently, we saw a relative spike in the premium for financial commercial paper versus non-financial commercial paper. You can see we got up north of 0.3. We hadn't seen that since 2016. I view that as an early hint of concern. The last time we saw much of that type of concern was back when there were a lot of fears about Brexit, and the uncertainty in the financial markets related to that was certainly reasonable. And we saw that that concern passed, and the commercial paper differential actually went negative. When it goes negative, that means that there's people are actually demanding less of a premium for financial commercial paper versus non-financial commercial paper. I view that as a general positive sign. And when it's generally low, I consider that indicating a generally benign environment. Certainly an environment where you're not going to get blindsided by a bunch of banks going belly up, or a major brokerage outfit having problems. And so the spike that we saw a few weeks ago, that was a cause for minor concern, but the drop we saw yesterday, actually the day before yesterday, to a negative number, indicates to me that we should be looking for some higher prices in here. That says that whatever they're worried about, they're not real worried about it currently. Is that a screaming buy? Absolutely not. That drop is a short-term indication. It's good news in general. It's what we want to see, particularly after a period of increased concern. But in this context, it certainly gives us more confidence about the next day or so, and it's a move in the right direction, implying that perhaps they're done being concerned about the financial sector. In any case, this little blip we saw up is far smaller than we saw up back when we were worried about Brexit, and if you go back to our last bear market after the financial crisis, you can see they had readings as high as looks like 2 or close to 2 on that, meaning there's 200 basis points more they're demanding for financial commercial paper yields versus non-financial commercial paper. It showed, and what's useful to us is that concern showed in the marketplace in the summer of 07, where you saw readings north of 0.4, several of them. As we went into that top in October, we were seeing a lot of high readings, far higher than we are now. That's what we want to be afraid of. If we see that sort of thing, you start paying close attention to your sell signals. That means that there's something's seriously wrong someplace. We don't know what it is. The smart money guys do. Let's let the devil take the hindmost. Currently, we're nowhere near those levels. So, I'm not at all concerned about a major bear market being promulgated by some sort of problem in the financial markets. It can happen, certainly, but it's very unlikely in the current context. And of course, something else could be a problem for the market as well. But given what we've seen in the current sentiment, I don't think that that's going to be the case. I think we have to give the bull market the benefit of the doubt. One of the other things we look at is the sentiment of active investors over at NAAIM. I like to see big shifts there, either in or out of the market, as something to perhaps trigger some buying. At the last low back in February, we saw a big drop in exposure, and that was the first buy signal we'd had in over a year and a half. It was spot on. It basically picked the low. I have the arrow a little bit left of the low, but that was the day before when the signal came. That was that night, and so the soonest you could buy was at the low, essentially, if anybody was that clever. And you can see it paid off handsomely. Now, we haven't seen that type of drop in exposure currently, but these guys over at NAIM they aren't dumb money. They're pretty smart investors, and they were heavily long the entire rally up. So I'm not. I wouldn't want to fade them just because they're bullish. I only view it as an indication of perhaps some uneconomic buying or selling when I see a big shift. Something that might be exploited by some smart money guys. Other than that, I don't. I wouldn't want to fade these guys just because they're 90 or 100% long. That'd be a great way to lose money, I think, in general. Near term this morning, I was looking at our sentiment polls on Fearless Forecasters, and Traders Talk is where we keep the Fearless Forecaster message board. These guys are all fairly sophisticated traders. They are uncanny at being positioned pretty much on the right side of things at major turns. So at a low, I would expect a lot of those guys to be long. At a high, I would expect a lot of these guys to be short. It's not necessarily a signal by itself. It's sort of an anti-signal. So if none of these guys were long as the market's making new lows, I would not be inclined to be looking for a low. However, this morning, these guys were heavily long. In fact, I think about 62, if memory serves, 62% of them were long. And bear in mind, these are traders. They change their position, oftentimes intraday. But they gave me a tipping point buy where they were 400% more fully long than they were fully short. That's both a short-term buy signal, which in current volatility probably means a little bit less, but also it means that they're heavily long. That's what I want to see if I'm trying to pick a low. And when we see these big big red and green bars stacked next to each other, that's kind of that multi-swing action is kind of what I want to see at a low as well. So at the very least, we've got a decent possibility of a low, and it's confirmed as a possibility by the fully long, fully short indicator here, which we keep. And by the way, this is available to the public. You can come on traderstalk.com and check out the Fearless Forecaster message board. The polls are posted at the top of the board. I run them every night through the morning till 9:15, and that's available to the public free of charge. You can use it in your work as you see fit. I would advise only using it as a measure for daily trading. Nothing. It doesn't really imply much over the long term, but short term it can be quite useful. It can give you a nice edge. Obviously, I wouldn't expect it to predict moves of more than say 20 points or something like that. But short term that can be quite useful for those who trade that actively. The other tool we look at here is our options oscillator, which is derived from the ISEE data. This has been a pretty good tool. You can see the signals have been, they paid off. It's a 1-2 day window. You saw the sell signal. You can see the sell signal here from last night. We did get some weakness today. That's not unexpected at all in the type of market we're in. This tool isn't going to be your tool to pick a market low, but you know, in a major correction, of course. But from day to day, within a an established trend, it can be quite useful. It'll give you a little more confidence anyway when you're trying to pick your spot. For instance, I'm not sure I would be in there today wanting to pick my low. I would, with that sell signal there, I would acknowledge that we could have a low, but there's also downside here. Of course, we had enough downside probably to fulfill the sell signal for that as well. But I would love to have a buy signal from the options oscillator, rather than a sell signal. If I was going to be stepping out in front of the market and saying I'm going to start buying here, pick a low, and take my chances. Again, if we saw that reversal stick that Tom was looking for, I think that'd be perfectly, it'd be perfectly okay to ignore the options oscillator sell.
Well, this looks great. I mean, I know I talk about sentiment a lot, and I've looked at the the name exposure charts and shown those as well during our sentiment. So I've already got people saying, "Can you add these charts?" So I know that no, I can't add these charts. Unfortunately, guys, you need to talk to Mark on his website about getting this information, I'm guessing.
Yeah, and if you want to see what it looks like on a daily basis, I get into this stuff pretty heavily. So, I'm looking at this every day, every night, and every morning. So if you want to take a look at the newsletter, so folks should feel free to stop by wallstreetsentiment.com. I'll give you 2-3 week. I'll add a week to the normal trial, so you can get a good hard look at it. Especially in this environment, it might be useful to see how sentiment behaves as we're trying to form some sort of a bottom, either successfully or unsuccessfully. I think it'll be successful, but that remains to be proven, I guess, at the moment. But yeah, I think NAIM is extremely useful particularly when you see volatile shifts in that sentiment. Similarly, ISEE can be very useful as well. When you see that, and when you see derivatives of ISEE showing big shifts, which is what I like to look at, is big shifts in sentiment. When you see big shifts to the long side, that's oftentimes a fade, at least very short term for a day or maybe a day and a half.
There's a lot of information there that you've presented, and you do have the trial offer there. So I think it would be excellent. And also, yeah, you do write for the Top Advisors Corner here on StockCharts.
Yeah, I do. It's a pleasure to do so. And thanks for having me on here. It's nice to be able to talk about all this stuff and have people pretend it's interesting to them.
I think it is. I think they would agree. We have lots of viewers, and that tells me they are very interested in this sort of thing.
I think some of the charts that you showed earlier, Mark, especially the relative VIX chart, I thought was really interesting. Where when it gets above its moving average by a certain amount, that a lot of times that will coincide with a market bottom, or at least one's coming. So it is a weapon that you should have as part of your arsenal if you trade the stock market. And I thought your information was very compelling.
Well, thanks a lot, Tom.